Hello, my friends. Today is June 1st, and this is Markets Weekly. So, today I'm in Orlando at the Rebel Capitalist Conference. Gave a talk this morning on Crash Up, had a panel with Brent Johnson and Mike Green, both big people on Twitter, and also had a podcast with Mark Moss today, who is very big in the crypto sphere. So, that's why I'm a little bit late today. All right, but of course, I did not forget you guys, and I had the chance to meet many of you. Thanks so much for being part of this channel. So today, it's going to be brief, but I want to talk about three things. First, I want to talk about the geopolitical escalation that's happening that I don't think the market is appreciating. Secondly, so we got some new data on commercial real estate, and it looks like the office segment has not yet bottomed and is getting worse. And lastly, looking at the latest inflation data, it looks like, the Fed inflation is slowing down, but looking just kind of at the path of the range of possibilities, I think the Fed has a pretty good chance of landing a soft landing. Okay, starting with geopolitical risk. So this past week, we had some, I think, meaningful escalation in the Russia-Ukraine conflict. So what happened was that President Biden authorized Ukraine to strike within the territory of Russia. Now, let's just rewind a little bit. Now, when this conflict began a couple years ago, everyone on TV was telling you that, this is going to be easy. They have sanctions on Russia, or the Russians run out of munitions. The Russians are just a gas station with nukes. They're no big deal. But fast forward today, all those predictions have been really, really inaccurate. Now, looking at what the White House has done over the conflict, over the course of the conflict, the White House has basically been crossing all the red lines it set. In the beginning, they were like, we would never send Ukraine tanks. Then they started sending Ukraine tanks. Then they said they would never send the Ukraine fighter jets. And then a few months later, they sent them fighter jets. Then they said they would never send Ukraine medium-range missiles. And then they sent them medium-range missiles. And all throughout this, it was always a big no-no to attack Russian territory. Now they're telling Ukraine it's okay to attack Russian territory. Now, I think this is a meaningful escalation of the conflict that's not being recognized in the markets. Now, my sense is that markets are not very good at understanding events that are happening across the world. Thinking back, I remember in 2020, we were all looking at the tremendous amounts of disorder caused by the pandemic in China, and the market just continued to go up. It was not until much later, when the pandemic spread to Italy, that the market began to react. So sometimes the market is not super sensitive to these big geopolitical events. So I think there's potential here for some significant escalation. Now, as we all know, there are factions in the White House who would really like to have war with Russia. They also know, and we all know, that President Trump doesn't want to have war with Russia. So, come November, there's a 50% chance that, maybe the war in Russia would be over. And so I'm guessing that the people in Washington who want war are seeing their window narrow. And so I think there's potential there for some surprise. So keep an eye out for that. So personally, I have found the legacy media outlets to not be accurate in reporting on the conflict. I really like YouTubers like Judge Napolitano, has many guests that are formerly of military, intelligence service, or diplomatic services that have given much more candid and accurate assessments of the conflict the past year. Okay, the second thing I want to talk about is we got all this new data about commercial real estate the past week, and it looks like commercial real estate is actually, well, okay, depending on the segment, there are segments of it that are continuing to do poorly. Now, as you all know, commercial real estate is a wide range of asset classes. You have hospitals, you have warehouses, you have retail, you have multifamily, and of course, you also have office space, which we all know is doing very poorly. Now, office space is doing poorly because many people are working from home. Now, some recent data shows that office space vacancies have actually continued to increase. So I've been reading headlines in the news about how a lot of companies are calling their workers back, but it looks like it hasn't been helpful. Now, in line with office space vacancies increasing, you also can see from this chart that office come from office spaces has been declining, negative growth. It looks like that's some continued stress and office space still hasn't found a bottom. Now, many people look at this and immediately think about the banking sector because about half of the commercial real estate loans are funded by the commercial banks. Now, when you look at this, though, the FDIC last week had their latest quarterly data, and you can see that some segments of the banking sector is experiencing higher delinquencies. In this chart here, you can see that so non-owner occupied commercial real estate held by large banks, that delinquency rate has risen and continues to rise. Now that's probably big banks that are heavily exposed to downtown real estate that's suffering. Now, to keep in mind though that these big banks are highly diversified and these portfolios are only a small part of their assets. The bulk of commercial real estate is actually held in smaller banks, and it seems like the smaller banks are managing their risk okay. Now, just taking a step back, looking at the banking sector as a whole, the FDIC's update shows that as a whole, banking sector loans, delinquencies, charge-offs continue to be, very well managed. Looking at this chart, it doesn't really seem like there's anything to be concerned about. Now, the banks have had a couple years to negotiate, to modify the loans and so forth, so I really don't expect this to be something that's going to blow up. Again, we have to be careful not to fight the last war. Now, the last thing I want to talk about is it looks like the Fed's chances of landing a soft landing are getting better. So we got the latest inflation prints the past week. Again, inflation's still too high, but it came on spot. So PCE was basically exactly as estimated, showing inflation is probably stabilizing somewhere between 2.5% and 3%. That is higher than the Fed's target, but it doesn't look like it's accelerating right now. Now, there's some interesting work done by the Fed where a bunch of researchers basically go and they look at a whole bunch of scenarios throughout the developed world where central banks, not just the U.S., just developed market central banks, have begun easing, and looking at the context where they start to ease, just how many episodes ended up being inflation under control. Of those, how many ended up being a soft landing, which is to say inflation under control and no recession. So this data is actually super interesting because you can see that out of the 149 episodes that the researchers found, only 25 were inflation abating. What that means is that the central bank is cutting not because the economy is in trouble and the central bank wants to go and support the economy, but because inflation is coming down, and so the central bank figures that it can lower interest rates. So most of the time throughout history, when the central bank cuts, it's to boost growth, and we've seen that over the past 20 years, right? So financial crisis, again, growth hit, unemployment up, Fed cuts to ease. March 2020, we had a huge shock to the economy. Fed cuts to try to boost growth, lower the unemployment rate. But this time around, it's different. The Fed is thinking about cutting, not because they want to boost growth, not because of unemployment, but because inflation has come down. So this current episode we're in is one of these fewer 25 inflation abating episodes. Now, when you look at 25 inflation abating episodes, roughly half of them end up in inflation failures. And what that means is that the central bank lowered rates and inflation came back up, so the central bank ended up having to hike again. But in a little less than half of the time, they actually were inflation successes, where inflation came down steadily to the 2% target. So right now we are in the inflation abating scenario, and given that, there's a good chance that the Fed, based on these examples, will get inflation back towards their target. Again, I don't personally believe that, but I could be wrong. Now, the last thing to look at is if you get inflation under control, what percentage of the time was it because you pushed the economy into recession, and so that ended up, getting inflation under control, Or what percent of the time was it a soft landing where inflation came down, but growth did not suffer? Again, of the 11 inflation successes, it looks like about half of them were actually soft landings. So right now, I think the Fed's chances, just according to this, are much better than what people thought earlier. Earlier, many people, let's say 2 years ago, everyone was saying that a soft landing, totally unrealistic. But as we go through this process, inflation has come down, and maybe it just really does get down slowly, and maybe growth does hold up. So we'll see. Again, I continue to think that inflation will stay higher than the Fed's target, but they will be cutting rates because unemployment rises not because of weak growth, but because of increasing supply from migration. Um, anyway, so again, today was relatively short. Again, it's been a busy day for me, but thanks so much for tuning in, and I will be back next week for Markets Weekly. Talk to you all next time.